Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, March 25th. The week started on a positive note for US equities and the dollar. Oil jumped on new tariff threats for countries that buy oil from Venezuela. So we are looking at you, China, and Tesla rebounded nearly 12% yesterday, and that despite the confirmation that BYD, the Chinese rival, earned more than the American giant in 2024 as its revenue surpassed the $100 billion mark. So let's talk. So as I said, the week started on quite a positive note for US equities, and optimism has been mostly put on the back of the early Monday hope that the next wave of Donald Trump's tariffs that are expected to hit the ground on April 2nd would be more targeted and more measured than previously thought. But Donald Trump still couldn't help himself, but he just said that the countries that buy oil from Venezuela will be subject to 25% levies. I mean, it is ridiculous, right? It is. I mean, if Trump is not happy about something, he will immediately go and threaten to put tariffs. But this strategy is obviously losing its initial impact right now, and investors are somehow learning to manage their emotions that are linked to these tariffs as such. Well, investors focused on the first wave of good news yesterday and kind of shifted to a risk-on mode for the US equities. The Venezuelan threat, on the other hand, moved oil prices higher. The barrel of US crude gained around 1.30% on Monday's trading session, but offers here weighed heavier into the $69.50 per barrel mark. Now, trend and momentum indicators here are growing stronger, mind you, hinting that a rise above the $70 per barrel level has a greater chance to happen in the short run. But the long-term demand and supply dynamics in oil markets remain in favor of cheaper oil in the medium to long run. That's an expectation that's already priced in, but could still prevent the oil bulls from gaining too much traction after a potential break, after a potential clearing of the $70 per barrel psychological resistance. Elsewhere, the Chinese equities are under pressure this morning as the country buys oil from Venezuela, and hence it is concerned by the new tariff threats from the White House. But for the rest of the market, especially for the US equities, as I said, Monday was a good trading session. The low risk assets like gold and treasuries sold off, the yields jumped, yet equities gained as a confirmation, as a hint of a risk-on shift in sentiment across the US markets. The S&P 500 jumped 1.76% despite higher yields, cleared the 200-day moving average resistance, and closed the session above this level. Nasdaq 100 rallied more than 2%, and one of the most severely hammered stocks of late, Tesla, rebounded almost 12% in just one session, and that despite the news that its biggest rival BYD, the Chinese BYD, surpassed Tesla in terms of revenue it made in 2024. The Warren Buffett BYD, Build Your Dreams, announced a revenue of more than $107 billion in 2024, while Tesla's last year revenue remained just short of the $100 billion mark. And profit at BYD jumped 34% to around $5.6 billion, but remained short of Tesla's $7.1 billion. So that's perhaps why BYD investors just prefer taking profit on the back of good and better than expected results, along with the fear of more tariffs on Chinese goods due to this Venezuelan oil story. So given the tariff story is hard to price in right now, it's very hectic, and we don't know if it's just going to go on or stop, or there will be one-off tariffs or no tariffs. No one knows anything. The price pullbacks for a company like BYD are certainly interesting opportunities to strengthen long positions, while for Tesla, the latest numbers continue to look bad. The company's European sales fell by 40% in February. Elsewhere, the US small and medium cap indices gained more than 2% yesterday, while the European indices were under pressure, with the Stoxx 600 index retreating 0.13% on Monday. As such, yesterday was clearly a correction of the rotation trade that hit the US equities and boosted the European and Chinese equivalents since the beginning of this year. Now, whether this is the beginning of the end of the rotation trade or just a simple correction is yet to be seen. The fact that the Federal Reserve last week showed its support to the economy despite the tariff-led inflation worries, and the fact that the European and Chinese stimulus news and measures have already been broadly priced in actually increase the need for new ingredients to keep this rotation on track. Because note that the S&P 500 tipped a toe into the correction zone earlier this month by posting a more than 10% sell-off from an all-time high level, but the index avoided a further fall into that pit. And equity strategists at JP Morgan, Morgan Stanley, and Evercore ISI, for example, now think that the worst of the US market downturn is already over. I, however, think that April 2nd could be another dark day. It will be another test for the global markets and the US equities because it could be a day of important capital moves depending on what will come out of the announcement of these reciprocal tariffs from White House, which will probably upset more than one. Voila. Note that the futures are all slightly in the negative at the time I am talking here this morning, and we are just before the European opening bell this Tuesday. For now, though, in the FX markets, the US dollar index has been benefiting from a broad-based rebound on relief or maybe fatigue from the tariff talk. The euro dollar shortly retreated below the 108 mark at yesterday's trading session, and that despite a set of stronger than expected manufacturing PMI numbers from the Eurozone countries, especially from France and Germany, which came on the back of the expectation of massive infrastructure and security spending from the European governments led by Germany, while services PMI came in lower than expected. But if we compare the two, manufacturing and services, well, manufacturing has a higher multiplier than the service-led spending, meaning that it could eventually have a more positive impact for the overall growth numbers than the impact from services. And so that rebound remains encouraging, though it is priced in. So yesterday's numbers were more positive than what they looked like in a first glance. Across the channel, the numbers told a different story. However, the contraction in the British manufacturing activity accelerated while services expanded faster. Now, British inflation and the spring budget announcement from Rachel Reeves will be the biggest drivers of sterling later this week, and there's actually a chance that we see sterling softening by the end of this week than otherwise, because Rachel Reeves has, well, no much choice left in her hands but to cut her spending plans, and that is obviously negative for growth expectations and for sterling if, of course, the Bank of England doesn't step in to compensate. And the BOE is not in a hurry, and HSBC now expects that the rates in the UK will hit the 3% mark in the third quarter of 2026 and not in the first quarter as they previously forecasted. In other words, the 130 resistance could be hard to clear for cable unless the US dollar experiences another wave of sell-off. Elsewhere, the dollar-yen cleared the 150 psychological resistance level on the back of a broad-based US dollar rebound, but the daily chart here recently printed a death cross formation where the 50-day moving average slipped below the 200-day moving average, which is a bearish signal, and the Bank of Japan's openness regarding further policy normalization in Japan could eventually limit the pair's upside potential into the 151.20, 151.80 area, including the critical 38.2% Fibonacci retracement on September to January rebound and the 200-day moving average respectively. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, and on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.